U.S. nat gas futures remained stable this week after 3 straight days of gains, marking the first rally of this kind since early August. Despite the recent uptrend, traders remain wary, pointing to ample nat gas inventories as a limiting factor. The market's response to the latest storage data and weather forecasts underscores the persistent uncertainty in the outlook. October nat gas futures closed higher on Thursday, boosted by the US EIA's latest weekly storage report. The report indicated a 35 billion cubic feet increase in working gas storage, slightly below the 5-year average of 41 billion. While this shortfall provided some temporary support, overall storage levels continue to put downward pressure on prices. Nevertheless, the ongoing reduction in the storage surplus remains a bullish factor, with inventories projected to increase by 226 billion cubic feet over the 4-week period from August 24 to September 20, a bullish 60 billion cubic feet below the 5-year average. If this projection holds, the current storage surplus relative to the 5-year average will shrink from 361 to 301 billion cubic feet. At the current rate of decline, around 2.4 billion cubic feet per day, the surplus could decrease to just 50 billion by the end of December. This is a crucial factor as we approach the winter season, especially with the growing LNG export capacity. These elements combined could drive the natural gas market into a more bullish state than even the EIA forecasts. For instance, while the EIA predicts a rise in gas prices to around $3.50, any colder than normal weather or panic in the European gas market could push prices significantly higher, potentially averaging above $4. Meanwhile, gas rigs fell prey to the 2-rig weekly loss, falling to 95, down from 97 last week, and down from 115 rigs 1 year ago. I think new gas drilling and completion activity will stay more subdued until nat gas prices recover closer to $2.75 to $3. Another factor that will soon push prices higher is the startup of 2 new Gulf Coast LNG export facilities in Plaquemines and Corpus Christi Stage 3, which are expected to begin operations by late 2024. WTI crude futures declined by 3% to settle at $73.55 per barrel on Friday, as investors factored in the likelihood of a rise in OPEC Plus supply starting in October, coupled with diminished hopes for a significant U.S. interest rate cut next month after strong consumer spending data. OPEC is expected to move forward with a planned oil output hike, despite recent Libyan outages and production cuts by some members to offset overproduction, according to sources within the group. Libya's eastern government recently shut down all oil fields, halting production and exports, which had briefly driven oil prices to a near 2-week high on August 26. On the data front, crude inventories in the U.S. are at their lowest since January, with Cushing, Oklahoma stockpiles at their lowest since November. Oil booked its second monthly drop this year, with Goldman Sachs and Morgan Stanley lowering price forecasts due to weak demand from China, the world's largest importer. Overall, the oil market enters the coming week with a mixed outlook, balancing supply constraints against demand uncertainties. However, if positive developments occur in Libya and Iraq, we could see increased downward pressure on prices next week. From a technical standpoint, nat gas prices are at a crucial juncture. Immediate support is found at this week's low of $1.93. On the upside, the market faces resistance at a short-term pivot of $2.10 and further resistance from the 15-week moving average at $2.16. These levels are crucial as traders continue to adopt a sell-the-rally approach, reflecting skepticism about the market's ability to maintain price increases. A breakthrough above $2.10 would confirm a bullish pattern. If this leads to sufficient upward momentum, a short-term rally toward the $2.20 pivot could be possible. Otherwise, prices may consolidate around the $2 support level until the potentially bullish storage report next Thursday. Please like, subscribe, and comment to support the channel. See you in the next one.